Hello, everyone. Welcome to the XTC 2020 Global Competition Bootcamps. Thank you all for joining us from all over the world. Today, his talk is going to be about what do VCs look for in a pitch. So please welcome Eric. Eric.
Shiva, thank you very much for this introduction. And thank you all for joining from all over the world. We are a firm doing some cross-border investment, and we are quite used to work with this different time zone. At BGV, we are talking 9 different languages within the firm. So thank you all for doing this effort. And as you know, of course, raising money is quite important to build the company. And that's always something which is a bit stressful because especially for early stage company, usually the management team or the CEO do not have experience to raise money. And I will try to give some tips or inputs to demystify this process. Very often people believe it's more complex than it is in practice. So this session is going to be split in two when I will address a few key points and obviously leave it for question and answer, which is maybe quite important for all of you. So having seen a lot of companies in my career, I would say there are 3 key points that I hope you will remember out of my few address. Number 1, I think, is that when you come to that, the first meeting has only one objective, and the only one objective of the first meeting is to have a second meeting. Don't forget about that. The other point is to be authentic. There is a lot of kind of voodoo around fundraising, and I would say at the end of the day, authenticity is what we are looking for. And number 3, I would say, is obviously to have a clear assessment of your competitive landscape. It's not about building a feature, it's not about building a product, it's about building a business. And it's very important for us to understand how you view your competitive landscape. As we are specialized VC, very often we may know the market a bit more than you. So basically, let's focus on the first point. When you come and the objective is to get a second meeting, it's all about differentiation. And, as especially early stage investor, we are a little bit trained. We have a kind of a mental model that allow us to have a feeling after the first 10 minutes of the presentation if for some reason we're interested or not. Sometimes we are wrong, sometimes we can pass on an investment which will make a lot of sense, but very often we are right. And I would say, what you need to address in that is very often, you're addressing a big market. VC are there to finance hypergrowth. And you can have hypergrowth only when the market is very large and for some reason underserved. So and I know the difficulty you have sometimes is very difficult to size this market because of course they are new market, but try to explain to the VC why the market is so big. The second aspect is what is the problem you're fixing? You cannot fix the whole problem of the world. So be very specific on the problem you're fixing and why, especially why it has not been done before. Why you're fixing the problem in a very original way. Very, very important. A lot of entrepreneurs forget to articulate this point. And the third point, which I think is key, and sometimes people forget about it, is show the adequacy between the team and the problem they are trying to solve. Why this team is quite unique to solve this problem, and why other competitor or big company will have difficulty to assemble such knowledge to fix this problem. And this is usually the step number 1, which will pick the attention of the VC. Say, I haven't thought about this problem. Oh, this is interesting. This team has a different view of the world. Let's dig into it. The second key point I hope you will remember is authenticity. I think you are who you are. Don't try to paint what you are not. And we see very often people trying to follow a predefined template or trying to make them, more advanced or bigger than what they are. Don't forget that the VC in front of you have been through the journey of building company, sometimes 100 times, sometimes 20 times. So we know exactly what it takes to move from where you are as an early stage company to a public company of $100 million or sometimes a company at $20 million. We know the journey. And what we look in this authenticity is people who are down to earth, they understand where they are, big vision, See if people are coachable, which is usually not be defensive when some questions are asked. And also, if you don't know, say you don't know. The things we don't like is when people try to invent answer on the fly, and it's very easy to figure this out. Don't forget that, especially on the early stage, we are specialized VC, and we may know the sector you're operating in pretty well. So it's very difficult to send some false information. The third point I would like to say is do your homework. VCs have a website which are pretty sophisticated, where you see their investment strategy, you see their portfolio, you see on which board the partner are. So you have really a map in front of you of who you're dealing with. And in my mind, I'm very surprised to see how many entrepreneurs sometimes are exhausting themselves, going up and down the VC route, not necessarily doing the homework or trying to understand which VC are qualified. I would say, especially in these days of post-COVID, where people are a bit retrenching to their core competence or their core investment strategy, it's very important to do this homework. If you're pitching to a partner who is on 10 boards, the likelihood of him or her to invest in your company is low because he has too many board seats. The average board seat of a partner is between 5 to 7. If you are doing an enterprise company, don't pitch to a firm who is specialized in B2C. So do your homework. Usually, some pretty good tools are done in the B2B space. A company called Emergence Capital has a very nice tool on their website where, depending on your subject, you can enter the description of a company, and they give you the list of the VC that could make sense for your business. So that's very important. There is nothing more irritating for us to engage in a meeting and discover that the entrepreneur has not done the homework. At last but not least, I think it's pretty important to have a realistic estimation or realistic positioning of the competitive environment. Very often, especially at the early stage, companies are led mainly by people who are product people or technologists, and we see obviously a pretty nice product features comparison. But as you know, the product feature comparison is not enough to build a business. So what is your competitive edge to build a business? Sometimes it could be technology. Sometimes it could be a very innovative go-to-market. Sometimes you build a community. And when we mean competitive positioning, we do not talk about product feature comparison, which is a de facto competition. So this is the few points I wanted to leave to you. I'd like to remember. Number one, why you're addressing a very important problem. Why is it a large market when you grow a business? Number two, authenticity. Show who you are, what you need to build the team, what do you miss, what are the help you will need from the syndicate of venture capitalists. Number three, do your homework when you visit the venture capital. And number four, competitive positioning is not a product feature comparison, but is how you're going to scale the business and compete with the rest of the market. So I'm going to pause here and be able to answer any question you may have.
Thank you very much, Eric. We have one question. Regi Bayu. Regi, you're on. Please ask your question.
Hi, I'm Regi from Hara, Indonesia. Regarding the market landscape, what is the best assumption to build up the strong market landscape? Because if we look at from the statistic from countries or any other source, we need to build up some strong arguments and strong assumption. Can you help to elaborate on that?
No, that's a very good point. You're right. By definition, a young company addresses an emerging market or is transforming an existing market. So by definition, there is very few data or statistics. So in that case, what we are very interesting is your reasoning. What are the various assumptions you have to estimate the market? The most frustrating things we have, what not to do if you want, is to come, I'm addressing $1 billion market, okay, which is typically what we see. And then we ask a couple of probing questions, and it's a bit unclear how people have come up. So you could size the market by, of course, the number of customers. You can size the market by the level of purchase that this customer will do at a unit level. It could be, if in the enterprise space, what would be using the land and expense model? What will be the transaction for your first landing in the account? Is it 20, 30K? And why do you believe that over time this could become a $500,000 transaction or 300? So we are more interested by the hypothesis and how we see the market. And by the way, this way you can engage the VC, because as usually we have a view on the market, we may give you other parameters. Don't forget, if you get the data of Gartner's or whatever, it's a bit too late. A lot of companies in the enterprise space, they come with a Gartner 4 quadrants. And we know it's kind of a fake, because, we know exactly how Gartner works and what it takes to be in the quadrant. So we are very interested by your reasoning, your hypothesis, and be also very clear which are the hypotheses that you're sure about. You have some data to back. Some hypotheses you're not sure, that you get some secondary data, because that's the nature of the risk we are taking. So when we do this exercise too, that's another way to get familiar with you as a management team and understand how you're thinking about it. Because don't forget, in this first meeting, we need also to get a strong feeling for the management team or the CEO and say, we want to continue to talk to this person because this person is quite interesting and quite genuine. So the way you express your understanding of the market is a way also to show yourself as a person, how you think, how you behave, which is part of the quote-unquote test in this first meeting. Second point, because you come from another country, as we do a lot of cross-border investment, another point I would like to address, don't have any inferiority complex. I know sometimes, especially if you, let's say from Indonesia or Korea or whatever, and you want to raise money in Silicon Valley, we notice that there is a bit of an inferiority complex. You should not have. I think in Silicon Valley, a lot of people are immigrants. A lot of people took with an accent, look myself, and it's fairly accepted. So just be genuine from this perspective. Obviously, your English should be fluent, but don't be, don't have a kind of a fear that maybe your English is not perfect. That would be a negative.
Thank you, Eric. Thank you, Reggie, for the question. We have another question from Juan. Manuel, Juan, want to ask your question?
Sure, thank you. I'm Juan from Tommy Digital from Colombia. So yeah, I was visiting Silicon Valley the last 2 months, like in January and February, having some pitches with investors. And I had the feeling that probably the investor had some like predisposition when the startup has the emerging countries as market. So that's, I really feel more like they are more comfortable if you are trying to reach a developed country market. I don't know if that's just a feeling of if that's something like normal, if finding this kind of VCs more focused in developed than in emerging countries market.
Maybe when you talk about emerging country, do you mean you're coming from an emerging country or you're serving an emerging market?
Yeah, we are solving an issue in emerging market. Yeah.
So you're totally right, Juan. In general, in Silicon Valley, you will see not too much knowledge about serving emerging market. But I will go to my point number 3, do the homework on the VC. It's pretty clear you have some VC who are investing in countries which are serving emerging market. Go after them. If you don't see any company on the portfolio of the firm you plan to visit who has invested in a company serving an emerging market, you have 0 chance. So it's a question of homework there, So do the homework.
Okay.
Thank you, Juan. Thank you, Eric. We have a question in the chat box from Damien Kudela from Cayuga Biotech. His question is, how much information do you want in the intro deck and first meeting to get further meetings?
Yeah, and that's exactly, that's a very important question. As I said, the objective is to have a second meeting. Don't overload the audience. You know this very well. In any presentation, on any event, the average human being is able to remember 3 or 4 things, no more. And this is well known. So is exactly the same for the venture capitalist. And on top of that, be aware that the venture capitalists have a bit of a kind of ADD. You will see them after 5-10 minutes, they start to hitch on their chair, because by receiving and working with startup all day long, we develop a pretty strong pattern recognition. So I think when you're in the first meeting, I would say, number one, try to focus on the 3-4 key points. I believe I tried to address them before, and that's what you need to hit. I don't think you can hit more, but very importantly, try to follow the audience. If you feel that for some reason people are back to the smartphone, typing text or email, there is indication you're losing the audience. I will make a pause at this moment and try to regroup and say, okay, what do you want me to address or not? For some reason, also at the same time, if you hit your point and basically the meeting is it will be shorter than what you planned, that's great news. Nothing prevents you to stop the meeting after 30 minutes and then say, okay, what's the next step? So in my mind, it's very important not only to deliver your message, but to monitor the audience. And then I will give 2 recommendations. Of course, if you're an experienced presenter and you at least to manage an audience, do it alone. But if you're not, and very often some of you may be raising money for the first time, it's a good idea to bring at least one of your team members who could monitor the audience and maybe help you to read or decode the body language. As you know, the body language is 50% of the information in a meeting. So I would recommend you to do that so that when you finish the meeting, you can debrief. And the person who was with you, whoever your co-founder usually can give you a read. The second point, if you come to with 2 persons, make a little bit of a role play. So that, let's say you're the CEO, you do the majority of the pitch. Don't forget to give a part of the presentation to your co-founder, because it helps you to catch your breath, react, regroup, and also look at the audience.
Thank you, Damien. Thank you, Eric, for your answer. We will stay tuned for any other questions coming in. Please use the raise hand feature or type your question into the chat box. Staying tuned.
JP, are you on?
Yes, hi, I absolutely am, but I haven't got my background kind of thing ready. And
that's all right.
That's
just
okay.
Just do audio.
Read your question.
Do audio, but
go for it.
I promise I'll get the background. So kind of a specific question, but Eric, thank you so much for sharing. And obviously, as the whole world knows, we're in this incredible crisis, and many startups have had to kind of refocus on some of the more profitable parts of their units. Obviously every day there's, retrenchments that have happened in different sectors and so on. So obviously it's challenging times. So I wanted to ask you 2 really specific questions. So in navigating through this, what is the best way that founders can address liquidation preferences with investors? And then secondly, if there's the possibility to have certainty of fresh capital, but at a down round to the previous valuation, how does one balance having that discussion and taking the certainty versus discarding that certainty and going out further on the hopes that some better terms could be arrived at later? So I apologize for the very specific nature of that question. Thank you.
Yeah, that's a very good question. And having lived myself through 2001 and 2008, I think it's a very appropriate question. I would say, I may try to be a little bit provocative, but I will come back to your question. Number one, the only reason why the company died without a business is because it's lack of cash. There are plenty of companies with great management team, great product, great customer, but unfortunately they have to cease operation because they're out of cash. Okay, so cash is by definition very important in these days. The second point I would like to address is that building a company is more a marathon than a sprint. Yes, there is always a focus about valuation and upfront and so forth, especially now because we've been living more than 10 years of an up market. So people have forgot all this issue about down run and so forth. But if you look at company went through that in 01 and 08, there were a bunch of company that got some down round or got some money that was more expensive than before and made it well. So at the end of the day, it's about cash. And if you have to take money with some tougher terms, it's all a question, or make sure that at least the money you take for this tougher term is enough or large enough to bring you to a point when you can create value inflection. Don't create crazy money for 1/4 of operation. It makes no sense. If you get tough money for, let's say, 6 or 7/4 of operation, that it makes a lot of sense, because you can build the company. So in my mind, if you're in a situation like that, you believe in your company, take the money with the right term, but make sure you get the money which allow you to operate long enough so that you can have an uptick in valuation the next time you raise money. And there are a lot of stories in '01 and '08 of companies that get terrible down round, but made it well at the end of the day. Usually, if you get money with a down round or tough terms, at least if you deal with professional investor, they will always make sure anyway that the management team is incentive and motivated.
Thank you, Eric. We have 2 more questions that came in. First, let's take the one from David in Novo Nutrients. David, you want to ask your question?
Yes, thank you. My question is, can you go into detail on strategy and tactics for doing successful fundraising in an era where it's very unlikely that you'll be able to physically meet and invest many investors, or have them visit your laboratory or see your team in person?
No, it's a very good question. And frankly, that's a question we are discussing in the VC industry. And you will discover that, unfortunately, it's very much linked to the personality of the partner. I think you'll have no problem to have a first meeting by Zoom or a video. That's not a problem anymore. Now, at the next level of comfort, you're right. Some people, for some reason, will not go over the hump. It happens to me recently. I've been working on syndicating a deal, and an investor was almost, I was sure he would come, he didn't come at the last minute because he couldn't feel comfortable not to meet the team. Some people will be upfront about that. So that's definitely a qualification question, you need to have, because it's very difficult to change the mind of the people. It's really the culture of the DNA of the people. I would say some firm like us who are dealing a bit more on cross-border are more used to that because, by definition, if you work with a company in Israel or in Europe or India, you have to start by a video call and all these type of things. So in my mind, try to look at the type of investment. If you see a firm which is doing only investment in Silicon Valley, and a very few cross-border, they are not likely to be very comfortable with this kind of a remote conversation. Which lead to the second question. As I said, this COVID has, in my mind, has a big impact because the chain of trust has been changed. What I mean by the chain of trust is who you trust, who you feel safe, has totally changed. So the VC are basically going back to their core chain of trust. So to alleviate this problem, the more you deal with people who know your investor, the easier it is. So we tend to rely more than before. Do we have somebody in a network who we know, David, for example, or somebody who works at Novo Nutrients? That will help a lot. So try to work this angle too.
Thank you, Eric. We have a chat question from KK. He says, we work in India, we have revenue with the US parent company. We find that there's a lot of interest in the US for our product, and we are raising funds to scale up so we can have a presence in the US market. What's the best way to pitch this to the investor? And would an investor see this as a seed investment or an earlier stage investment?
Okay, so I think this is at least cross-border investor with India. We are one of them, and there are a fair amount of investors doing this type of things in the Valley are very cognizant of this problem. So there I would just focus on the firm who have done a fair amount of cross-border investment. I don't know in which sector you are, so if I have a bit more color on the sector, I can be more precise. But in general, I would say the tech sector, the market in India is quite respected. We know it's a tough market. Price points are low. So a company who has been able to win customer and traction on the technology side in India has a certain amount of credibility. So there will be definitely interest of the U.S. cross-border fund to study your case. Now, the things you have to check, and that's pretty valid for every cross-border investment. You may be the number one or number two in India, but you have to make sure in US you don't have too much competition. So for the specific issue, to get a strong understanding of the US competitive landscape is quite important, because if the US market is saturated for your sector, you're not likely to attract investor. If for some reason the US market is quite open for you, there will be a lot of interest.
Thank you, Eric. We'll take one more question that came in from Arya Shah. And the question is, what tips do you have for a company that is pitching based on an idea and a minimum viable product as opposed to a production-ready product?
No, it's a very good question. At least before COVID, the market was very, very well structured. Typically, if it was a product idea, we were pretty clear in the seed investment stage, million or million plus. And then as soon as you are moving from trying to build your minimal viable product, you were entering the seed plus or the small series A. And then when you are production ready, so the market was very, very well segmented. Now, let's be honest, this COVID is putting everything back on the drawing board, I would say. And I'm a bit afraid I may not be able to give you a very clear answer there. In my mind, the earlier you are, the more you should go after investors who really know their space. So I would say if you're pitching an idea, try to find a firm or a partner or an investor who really understands your space, because obviously because of COVID, we are all revisiting our risk-taking. And the more you know, the more you're likely to go early. The less you know, the more you're likely to wait for a production product. So it's back to my advice, do the homework on the investor you're pitching to and try to pick investors who really understand your space.
Thank you very much, Eric. We have a few more questions that we will hopefully get answered through the next sessions. Or could you suggest a way, if anybody wants to contact you, how they can get in touch with you?
Yeah, I think please feel free to send me an email. My email is simple. It's my family name, Buatois, at bgv.vc. So family name, Buatois, at bgv.vc. And Rajiv or Barrett, feel free to send my email to the team.
Thank you so much, Eric. And that was a wonderful kickoff session for us for the bootcamp. I think you gave us a wonderful takeoff for going into the next session. So thank you very much, Eric.